Joining us this morning, California State Teachers Retirement System CIO Chris Ailman, over $300 billion in assets under management. Chris, it's good to see you. It's interesting to mark this anniversary because as bull market recoveries go, this has been about the softest since the '87 crash.
No, that's true, Carl. And a very solemn day. I can't believe I'm following the news stories that we've just seen. And that's what I think the future is going to hold. Real uncertainty, geopolitical risk. Climate extremes. It's going to be tough for the market, I think, to move ahead, and mostly because of higher interest rates.
So with that backdrop, how do you characterize your appetite for equities, and what kind of, how do you make hay with this environment in fixed income?
You know, it really is all about asset allocation and diversification. You can make a decent return in fixed income. Look at the yield curve today while bonds are backing up. You know, you can get 5% on the short end of the curve, and you know what? You can get almost 5% on the long end of the curve. So the curve is flattening, which is a good sign for moving ahead. But I agree with what Paul McCulley said at the top of the show. Higher, instead of higher for longer, just high for longer. And I'm going to add high for much longer. Doesn't sound as catchy, but I think interest rates are going to stay up in this 4 to 5% range for a long time. Because inflation, as we saw today, is spotty. It's very persistent.
Chris, that certainly is the intention, it seems, of the Fed, to try to keep rates at these levels indefinitely until they really see inflation wrung out. But doesn't something usually come along? I mean, as a bond investor, don't you have to anticipate the possibility that the path could be different, whether the economy buckles, there's some kind of a shock? And I wonder if that would make it more attractive as a long-term investor to lock in longer-term rates at these levels.
Mike, you're spot on. You got to do your homework, and I think you have to be in both ends of the curve. It's interesting, you know, that you have high at the short end and then a bit higher at the long end. The belly of the curve is inverted. But it's a time where you've got to be diversified. Geopolitical risk is higher than we've seen it in many, many years. And I just really want to emphasize that inflation, while it's lower, as we saw today, it's spotty and just darn persistent. So I think by doing your homework, you've got to know your credits. This may be the soft landing. It doesn't feel very good, but this is maybe what it is, that we just muddle along for an entire year and the market stays fairly range bound. You'll have 7 stocks that do really well, but not all the stocks are going to do well.
Have you changed your thinking and exposures, Chris, to big cap tech?
You know, Sarah, we own the market, so we're exposed to big cap tech, and it's the top weighting in our portfolio because we own the U.S. market as one whole block. What we've changed our thinking on is diversification. We definitely have a fair amount of money, and we're increasing our exposure to fixed income. We like private credit. You know, the real estate market, the private equity market are absolutely just locked up right now because of these higher rates. People have not readjusted. So, you know, we're going to be in equity. We're going to be in global equity. And yes, we're going to be mostly in the large caps. Small caps look interesting, but they don't do well in this kind of a high interest rate environment.
You mentioned private credit. Obviously, there's been something of a rush into that area. Is that just because at this entry point with yields at these levels where you can originate new loans is attractive, or has it been the case all along the way? Have you been in that area, and are you confident it can weather the turbulence now?
I think it can weather the turbulence, Mike, if you do your homework. I've got to emphasize that. You've got to do your credit analysis. You don't want to just buy blanket pools of private debt. But the banks have really stepped away from this marketplace after '08, the capital requirements. So there's a gap in there in the cap structure that gives private investors the opportunity to loan money, either asset-backed. People are looking at private loans. You can be very senior in the cap structure and get a very decent rate of return. So I think, if anything, I'd say fixed income's back. It's a place to invest, and it's a place to diversify your portfolio.